So following on from our first workshop, Investing 101, which covered the mindset and mentality you should have when it comes to investing. Um, the second workshop that we did as well, which was portfolio instruction, which dived into the process of creating an investment portfolio so to meet your investment goals. Our final workshop today will be on portfolio optimization, which will cover how you can get the most out of your portfolio by optimizing some of the costs incurred as part of your investing journey. So on the agenda today, we'll once again start off by touching base on the InvestNow investing principles, with a focus of today's workshop being a deep dive onto the last principle that we've yet to cover in these workshops relating to the impact of fees and tax on investments. We'll then go into a high-level overview of the various fees you should be aware of when investing, as well as how tax is generally treated when it comes to investment gains. We'll also apply some of these insights and learnings into a worked example, comparing some of the different fees, costs, and tax involved with the different S&P 500 investments you can access here in New Zealand, and why being wary of some of the impacts of these costs when selecting your investments can lead to quite a meaningful impact on your ultimate investment returns. Finally, we'll go into how you can apply the valuable lessons that you've learned from this workshop today into your investing journey before opening up to a Q&A at the end. So if you have any questions, please do fire these through in the chat box and we'll try to get through as many of them as we can. Just for some housekeeping though, please note that everything that I will be discussing here today is just for general information purposes only. So purely educational, neither I myself nor InvestNow provides any personalized financial advice. We are, however, strong advocates for it, and we actively promote the benefits of seeking personalized advice from qualified advisors. So with that out of the way, let's jump in then. So today's workshop, first thing again, we want to really highlight and bring up is once again the InvestNow's 10 investing principles. So these are our guiding principles that are intertwined in everything that we do to help guide Kiwi investors towards long-term investing success. So each of these 10 principles has an important investing lesson embedded into them, and it's stuff that's so fundamental it applies to a complete novice investor to a seasoned investor alike. So we started our first workshop with the foundational investment principles that shaped a whole holistic approach to investing, moved on to the second workshop that covered the principles when you need to be aware of when you're constructing a portfolio. And finally, today, we'll cover the last but certainly not least investing principle, which represents what you should keep in mind when trying to optimize or make the most out of your portfolio's returns. Codified in our final principle, fees and tax are important, but not everything. So let's dive into this principle then. So at its essence, it's really quite simple. So there are a lot of things that we have very little control over when it comes to investing, such as the performance of companies, the economy, inflation, interest rates, yada, yada, yada. There's so many things we can't control out there, and that means it makes our future investment returns unknowable. When it comes to investing as well, as of anything you buy, there are fees and costs associated with investment products and services. So the cost of investing can be both upfront as well as ongoing. But these costs are actually one of the few things that we can somewhat control when it comes to our investing journey. So it's important for us as investors to understand the particular impact that fees, taxes, and other costs has when it comes to investing. As while they can often seem small, they can have a major impact on the investment returns we ultimately receive. So these ultimate returns are really driven by three key factors. So one is the gross returns from the investments that you invest in. So gross meaning it's before fees and before tax. So if the fund has performed 10%, then that's your gross return before you've taken anything away. Next thing to be aware of is obviously fees. So the fees you pay to access that investment. And the final thing that will drive your final returns is the tax paid on those investment returns. So what we really want to highlight here is that it doesn't really matter what your gross returns are. We as investors should really be concerned about the net returns, because that's actually how much money or return we've made that we actually get to keep in our pocket and use for our financial journeys and living our life, right? So it's kind of similar to, when you get paid your salary, most of the time we don't really care what that gross amount is, right? All we care about is the take home pay, right? Net of all the taxes that we pay, all those fees, those ACC fees and those niggly KiwiSaver stuff we pay, right? All we care about is what we actually get at the end of the day, so that's what we can spend on. Similar thing with returns, right? So it's the net returns or the take-home returns that we should be concerned about. So it's really prudent not to ignore the impact of fees and taxes. So let's do a little bit of an overview of the different fees involved when it comes to investing. So we're not trying to get across every single fee here, but as an investor, as really meaningful to at least be aware of some of the major fees that you have, which really boil down to two different categories. So you've got ongoing fees, which are charged basically every year, typically as a percentage of your portfolio. And then you've also got transaction-based fees, which are charged each time you buy or sell an investment, and it's only on the amount that you transact rather than the entire portfolio. So in terms of the ongoing fees, probably the major one that most investors would be aware of is the management fee. So these are the management fee that you pay when you invest into any fund or ETF that goes to the fund manager to cover the cost of actually managing and running the fund. So typically, these are almost always as a percentage of the fund's assets. So if you have a 1% management fee, if you were to invest $100 into the fund, then at the end of the year, if the fund hasn't moved up or down at all, you should be getting $99 in your portfolio because $1 has gone to the manager for their fees, right? So generally speaking, when it comes to management fees, passive or kind of index tracking funds tend to have lower fees, somewhere well within 1%, probably close to 0.5%, if not lower, whereas active funds or funds that try to outperform benchmark tend to be a bit more expensive because there's a lot more cost involved to actually research and try and beat the market. So generally speaking, active funds tend to be somewhere between 1 and 2%. So most of the funds we have on InvestNow, they go as low as 0.03% for management fee and as high as kind of I think 2.5, somewhere around that region. Next kind of major ongoing fee to be aware of is performance fees. So this is something that you may not actually, be aware of, but there are some active funds that charge a performance fee if the fund manager were to outperform a certain benchmark. So the benchmark could be, for example, if they bet the S&P 500 by more than 5% in any one year, then they may be entitled to, let's say, 1% of those, additional gains. So really be mindful of what the performance fees are because some of the funds can be quite excessive. But at the end of the day, if the manager is beating the benchmark, there's not necessarily a bad thing to be paying performance fees. But again, just to be mindful of what it is. Next thing to be aware of is platform fees. So these could be either a percentage of your portfolio or just an annual dollar charge that's charged each time you use a specific investment platform or provider. So there are certain KiwiSaver schemes, for example, that will charge you something like $12, $20 a year to be part of this scheme, or there are other kind of investment platforms out there that will charge you like a monthly fee, like a $5 per month to use their service. So be mindful of what those platform fees are because they can kind of add up meaningfully over time. Next, in terms of the transaction-based fees, to be most common one is probably the buy-sell spreads, and to a lesser extent, swing pricing. So they both basically do a very similar thing in the sense that whenever you buy something or sell something, the amount that you actually buy or sell in terms of investment units gets reduced by a certain percentage, which is that buy-sell spread or swing pricing. And basically that's retained by the fund to cover the cost of trading. So if you were to invest, let's say $100 into a fund and then a buy-sell spread of, let's say 10 basis points or 0.10%, then effectively only 99.9 goes into the fund and 10 cents is scored away by the fund to cover the costs when they eventually go and actually go to market and try and buy and sell the investment. There's always costs involved. So basically, user investor just needs to be aware that gets reduced a little bit every time these buy-sell spreads involved. Entry and exit fees are very similar to buy-sell spreads in the sense that, once again, as an investor, you just basically the amount that you buy or sell gets reduced by a certain percentage by that fee. The only difference is rather than that fee being retained by the fund, it gets basically siphoned away to the fund manager, which again just uses it to pay the costs of ongoing management of the fund. Finally, you have brokerage and commissions, which are basically the types of fees that platforms out there like Sharesies, Hatch, Stake, and other kind of brokerage, share brokerage platforms charge. So anytime you basically transact, there'll be a charge. So if you were to buy an ETF, for example, then there'll be a charge that they charge, for their brokerage. If you were to transact and move, changing your NZD to USD to buy the ETF, then there's another charge. So generally speaking, I think the foreign exchange fees typically start around 0.5%, so it can be quite significant. And then brokerage can be somewhere, again, another 0.5% or 1%. It could be a dollar-based fee, kind of. I think Hatch is like $3 per trade kind of thing. So really just be mindful of all those costs. So, we'll kind of discuss costs here, and, some of the numbers probably don't stand out to you guys a lot, right? So I'm talking kind of 1%, 0.1%, 0.5%. Doesn't seem like it's going to matter that much at the end of the day, right? So why bother, trying to optimize all these fees? So one thing that to really keep in mind is that when it comes to fees, although they may seem small, they can compound to be quite significant impacts on your investment portfolio over time. So let's just try and visualize this a little bit. So we're going to use an example here, and basically we're going to invest into a fund, and all this fund does, it's, we've got 5 different funds here. They've got different investment management fees per year. So starting at 2%, 1.5%, 1%, 0.5%, and the lowest fund fee we have on the platform, 0.03%. So what we're doing here is we're assuming that all these funds return the same gross percentage of 7%, and then the net percentage that they actually return would be less that fund fee. So if you get charged a 2% fee, then the net return you get per year is 5%. So what we're going to do is we're going to say you're going to invest 100K as a lump sum when you start working, so somewhere around your 20s, and you're going to see how much that grows when you retire at age 65. You're not going to put any more money into that investment pot. We're just going to let it compound over time, and you're purely just going to see the impact of fees. So at the end of your retirement, this is the difference. So for the lowest fund fee, basically your portfolio went from 100K to over $2 million. Whereas on the highest fund fee at 2%, your portfolio went from 100K to just under 900K. So basically a whopping $1.1 million in difference. And it's purely off the back of fees. So this is a hypothetical example, and obviously you're not guaranteed to get this amount of returns every single year, but it's really just there to highlight the impacts that fees can have, in a very similar vein to our first workshop where we highlighted the impacts of compounding returns. Because if you really think about it, all fees do is just erode your returns, right? It's just a negative return. So the more you are able to minimize that negative return, it's basically a positive return for you, right? So, and as we learned in that first workshop, the higher your return and the more consistent you invest, then over time, the difference can be very meaningful, right? So basically your portfolio can go from increasing just 9 times over that period to a whopping 21 times, right? And who wouldn't be happy with an extra 2 mil at the end of their retirement period? So do not ignore the impact that fees can have, because even the small amounts can lead to some very, very big impacts. Moving forward a little bit now. So what we're saying here, although we did highlight the importance of trying to minimize fees and how that can impact you, at the end of the day, though, it's really important to really understand that second half of that principle. Although fees and tax are important, they are not everything. And the reason why we say they're not everything is you shouldn't view fees just in isolation, because you should really understand what you're getting out of those fees. So the value you're getting from the fees is more important than the fee itself. So for example, if you were to be investing into an active fund, which is trying to outperform the benchmark, generally speaking, active funds tend to charge higher fees, but then those higher fees may be well worth it if the active manager has a consistent track record of outperforming the index, right? So then therefore you'd be happy to pay, an extra 1% in fees if it means that the manager is getting you an extra 5%, for example, in outperformance, right? So that's what we call value there, right? So again, it really just depends on what you're trying to achieve with those goals, right? So if you're trying to invest in an active fund, the value there is by outperforming the benchmark by more than the traditional fees you get charged by active managers. Contrasting with passive funds, because we know passive is effectively just trying to track the index, what value there is means that you want a passive fund that actually accurately tracks the index, right? Because there are a lot of passive funds out there at very low price points, but some passive funds may not actually be very good at doing what they say they're going to do, right? So if they're trying to track the S&P 500, for example, the S&P 500 went up 20% last year, and the passive fund only tracked it by going up 18%, versus another passive fund that tracked it by going 20%, then you've lost out on that purely behind the actual value behind that passive investment. So very, very important to keep that in mind. And then finally, there's also non-financial factors involved, right? So you could be sitting in investment purely because you like the good that they're doing in the world in terms of the ESG investing, or you like the UI of the investment platform. There's a whole bunch of reasons to spend a little bit more money, and could be well worth it depending on what helps you, on your investment journey and get you to consistently invest. That's what's most important at the end of the day. So value, keep that in mind. Moving forward a little bit to tax now. So I know, we talk about tax, everyone kind of shies away and probably everyone's going to drop off, right? But tax is actually quite important. It's one of those things, death and taxes is probably the only 2 unavoidable things in the world. And, investments, and it's not the exception. So every time we invest, there's always going to be tax to pay. And it can seem really overly complicated, but like fees, it can have a significant impact on your returns because this is just another drag, right? So if you kind of minimize your tax liability, then that actually maximizes your return and you kind of get those nice compounds. So I thought we'll first kind of highlight just the key differences between tax treatment of PI funds or portfolio investment entities, which we primarily deal with here at InvestNow, and non-PI funds. So, or if you were to invest directly in, say, underlying shares like a Tesla, Microsoft, Apple, or invest into like a term deposit, etc. So it's different whether that structure is in a PI or not PI. So if it's a PI fund, then that's taxed at your prescribed investor rate, or your PIR. So that's capped at 28%, which is quite a key kind of benefit, especially for those investors on income levels above 70K, because then you'll be on a marginal income tax rate of 30%. So or anyone above 30%, so 30, 33, 39. If you're one of those marginal income investor tax rates, then under a PIE regime, your tax rate is just kept at 28%. So some significant benefits there. The other benefit of the PIE fund is that there is no tax admin. So the PIE will basically take care of all the tax for you. The manager and the custodian will basically do all the work. So it's basically set and forget. So very easy for those of us that are lazy out there like myself. And then finally with PIEs, and we'll kind of go into this a bit further, they have a unique approach to taxing foreign investments, which I know is very popular here at InvestNow. So foreign investment stuff like the S&P 500, when it comes to PIE investments, they basically have a fixed approach, which caps your tax bill each year at 1.40%, which basically means that, under this fixed approach, or FDR approach, which I'll go into a bit more detail later on, effectively your gains each year on your portfolio are capped at 5%. And then if your 5% is your taxable income, and at the 28% PIR rate, 28 times 5% gives you your 1.4% cap tax bill. So contrast this with the non-PIE investment. So if you invest directly into like offshore ETFs that aren't PIE structured, or invest into direct shares, then the maximum tax rate is your marginal income tax rate, or RWT, which caps out at 39% for those earning over 180K. So there's potential tax admin involved as well, because nothing's taken care of. So if you are making significant gains, then you may need to file a tax return. And then I guess the key benefit though of the non-PIE investments is you do have a choice of how your foreign investments are taxed. So you can either go with the same approach as the PIE investment, the cap it at 5%, or you potentially, if you've made less than 5%, you can have the actual gains you made and calculate based on that. The key thing though is that with these foreign investments, the maximum tax bill you'll receive is capped at 1.95% of your portfolio each year, and that's reflective again of that 5% maximum capped return times 39% of your tax rate, 1.95. So go into that in a little bit more detail soon. So here's a bit of an overview of these tax rules. So if you are, I know tax can get very complicated, so this is a high-level approach. I'm not trying to be a tax expert. I'm not an expert myself. I'm not trying to make you guys experts either, but just to be aware of some of these overarching rules. So when it comes to fixed interest, stuff like bonds, term deposits, if you're investing not through a PIE, then you have all your gains, whether it's interest or capital gains, are taxed at your marginal income tax rate, or RWT. When it comes to New Zealand shares, if you're investing directly in a Fisher & Paykel or a Pushpay, or in New Zealand, then basically your tax bill is only limited to the dividends that you received from those investments, unless you are selling those investments, for profit and you're deemed a trader. So it's a bit complicated how those rules work, but I'm happy to kind of answer any questions on that front. And the ID can be quite sneaky in terms of how they apply that. And then finally, the kind of other main tax rule to be aware of is those foreign investment fund, or fifth tax rule. So that's when you invest into any foreign investment. So whether it's an Australian unit trust, direct shares, offshore ETFs. So usually most of the investments you would have on those share brokerage sites would be under the fifth. So when you have fifth investments, there's three ways to to calculate your tax bill. If those fifth investments are less than 50K in cost, then you fall under the de minimis exemption, in which case you only need to pay dividends. You only need to pay tax on any dividends you receive from these fifth investments. If your fifth investments are over 50K, then that's where you need to choose between either the fair dividend rate or FTR method to calculate your taxable income, which under FTR is 5% of your portfolio value, or under the CV, or comparative value method, which basically calculates your actual gains and loss from your fifth investments that year, and that's your taxable income. So if you made 10%, then you are taxed at 10% of your gains, time, let's say your tax rate is 30%, so you'll be charged basically 3% of your portfolio. So in that case, you would probably choose fifth, because then it's always kept at 5%. The drawback of fifth, obviously, is even if you've made less than 5%, then that's the amount that they've deemed you have gained through that period. Cool. Okay, moving forward a little bit. Basically, the other key thing to be aware of with tax is that when you're comparing different tax, comparing the tax efficiency of different investment options, just keep in mind these three key considerations. One, the tax rate that's applicable. So as we mentioned earlier, PIE funds are quite beneficial in the sense that they cap your tax rate at 28%. Otherwise, if you are a marginal tax rate investor earning above 70K per year, then you would be paying a high tax rate. The other key element to be aware of is tax leakage. So this basically occurs when the underlying investment that you're investing into isn't structured completely efficiently. So generally speaking, that means that the underlying investment where it is domiciled is a different country to the actual investments that they are trying to invest in which case they're not not eligible for certain tax credits, which basically acts as a drag on your return. So keep in mind tax leakage as well. I'm happy to answer any questions on that in the Q&A. And then finally, just keep in mind whether you're someone that's actually got the time, knowledge, requisite, details and effort and willpower to actually do your tax admin. Because if not, then PI funds could be your kind of your saving grace. Cool. So let's apply some of this all together now. And let's see the impact of fees and taxes on the various different S&P 500 investment options in New Zealand. So we'll basically break down all the different fees involved here, starting off your transaction-based fees and then as well as your ongoing fees. So we're starting off with the Foundation Series, a US 500 fund. And the key thing with this comparison that I'm going to do here is that they're all investing into the exact same thing, all investing into the same S&P 500 ETF from Vanguard, or otherwise known as VOO. With the Foundation Series fund, we charge a transaction-based fee of 50 basis points. And then the ongoing fee is limited to just a super low management fee of 3 basis points and a PI tax cost of 1.4%. So the way I worked it out again is under PI funds, maximum deemable taxable income is 5% each year. Time multiplied by that 28% PIR gets you 1.4%. So ongoing cost of 1.43% per year. Next option, we've got the Kernel S&P 500 fund. So very similar to the Foundation Series, again, invest into the same ETF, but Kernel doesn't have any transaction-based costs, and they only have a higher management fee at 25 basis points. And because it's a pie structure, again, 1.4% in tax, meaning your ongoing annual cost is 1.65%. So what we're going to do here is compare all the different costs, and then at the end, we're going to see what your portfolio value will look like if you were to invest for 10 years based on these costs. Next option, we've got the Smart Shares US 500 ETF. So if you were to buy that through Sharesies, they charge a transaction-based cost of $25 NZD. And then they've also got a higher management fee with that Smart Shares option at 34 basis points. Plus, again, it's a PI, so 1.4%, so ongoing cost of 1.74. Then finally, we've got options for the Vanguard S&P 500 ETF or VOO if you want to invest directly through one of these brokerage. So Interactive Brokers, Hatch, Shares You Stay, they all charge different kind of transaction-based fees and brokerage-based fees. Key thing to be aware of, though, is that because you're going directly into this ETF, it's not a pie structure, although you get the benefit of the super low management fee at just 3 basis points, that pie structure means that you do pay the higher fee here. So we're assuming that you're on the 39% tax rate multiplied by a 5% maximum FDR taxable income, gets you 1.95% in maximum ongoing taxable each year. So if you were to invest 100K at the beginning of the 10-year period and then applying these underlying fees every single year, and we're assuming the S&P 500 has returned 9% every single year, this is what your portfolio will look like. So you can see on the Foundation Series option, you've got just over 200K or made a total return of over 100%, whereas the worst performing option is their stake option because of that high kind of brokerage or currency fee that they charge of 1%, plus another brokerage of 1 basis point. At the end of the 10-year period, you've only got $190,000 in your portfolio. So, again, the key thing is they all invest into the same underlying investment here, right? So nothing's changed. It's just purely the fees and tax structure. And we've calculated every single cost involved when it comes to these investments. So if you really take the cost and tax efficiency into equation, you can see that a really tax efficient or cost efficient fund can provide, like a Foundation Series, for example, can provide returns up to 15% higher compared to other options. So obviously you need to caveat that you're not guaranteed to have these returns year on year, and your situation could change. So it really depends on what your individual circumstances are, but it's really here is just a good example of highlighting the impact that fees and tax can really have on a portfolio. So finally, just a few key things to keep in mind when you're applying all this to your own investor journey. So one, when you're trying to optimize your portfolio going forward, do make sure you compare all the fees involved. So it's not just the management fee. Do consider, for example, is there any platform fees, are there any performance fees? Refer to section 5 of the PDS, which generally outlines all the different fees involved, or the investment platform provider's website for all the details. Second thing to keep in mind is really understand the tax rules, right? So understand what kind of tax treatment the potential investment you're looking at is going to be on the hook for, and keep in mind, for example, some of the efficiencies of certain structures like PI funds. So another good resource would be the InvestNow tax guide as a good starting point to understanding some of these rules. Third thing is to really keep in mind that, when optimizing for costs and fees, it really depends on your own individual circumstances. So that's stuff like your individual time frame, investment frequency, and tax rate. So in the example I used before, it's based on a certain scenario, right? Or if you're a long-term investor, you're not investing too frequently. It could completely change if you're a short-term investor or you're investing very frequently or you're on a lower tax rate, for example. So you make sure you just incorporate your own individual circumstances and all that. And finally, at the end of the day, like as we mentioned earlier, fees and tax are important, but it's not everything. So make sure when you're trying to optimize your portfolio, you're optimizing the actual value for money you're getting, and it's making sure it's actually helping you towards your investment goals, right? So there's no point in trying to minimize the fee if you're getting very poor service out of it or getting a poor investment product out of it. So just make sure you're getting the most value out of your investments that will actually help you achieve your investment goals. So that brings us to our Q&A now. And apologies, I probably went a little bit over time, but happy to take any questions that anyone may have. So hopefully we have some questions. So let me just bring these up. Got a few. Okay, so I've got one question here. If I decide to reorganize my portfolio, e.g. shifting from one fund to another, is there a time of year which is optimal to do this, or the sooner or better? Yeah, that's a great question. So when it comes to reorganizing your portfolio, you can it depends what you mean by reorganizing. So reorganizing could be a simple rebalancing of the portfolio. So rebalancing, as we kind of discussed in the last workshop, is where you're basically just bringing your asset allocation back to the target. So it could deviate, month to month, year to year because of market movements. And rebalancing is generally recommended to be done once a year at least. When it comes to basically changing the investments altogether, so basically you're going from one investment to another, that would really be dependent on if there's been a massive change in your investment circumstances. So for example, if you bought a house recently and you all of a sudden don't need that deposit, you want to go more into growth funds like growth options like shares, then all of a sudden it's a good time to reconstitute. So it's not necessarily dependent on the time of year. It's more based on your own circumstances, right? So, if you buy a house and you no longer need to be conservative around your investment strategy, then all of a sudden you should be trying to change it to a more growth-oriented one as soon as possible. Not necessarily wait till, let's say, I don't know, end of the year when you've got time. So, yeah, just dependent on your individual circumstances, not necessarily the best time of year to do that. Next question: Does the InvestNow S&P Foundation example still work if you are making small regular investments? Yeah, so that's a great question, and it does work. So the reason why that InvestNow transaction fee of 0.50% applies just to the amount that you buy or sell. So it doesn't matter if you invest 100K in a lump sum, or it doesn't matter if you split that 100K into $1,000 increments. At the end of the day, that transaction fee is only ever going to apply on the amount that you're investing, right? So you don't get pinged twice, if that makes sense. It does change things a little bit if you were to be investing a significant amount for a fund that has a large management fee, for example, because with management fees, they're not based off the amount that you're transacting, they're based off the entire portfolio. So, but obviously it's a catch-22. The more you invest at the earlier on, then the more you are able to basically get the benefit of the market, or potential detriment, depending on how the market goes. So short answer to the question, no, it doesn't matter too much on that. Next question now. Just trying to find the next one. There's a lot of repeat questions. Okay, what are the impacts of hedge versus unhedged strategies, i.e. currency hedging on a portfolio returns and taxes? Yeah, that's a great question. So with hedge and unhedged strategies, I probably won't go into too much detail of whether you should go hedge or unhedged, because it really just depends on your own individual risk tolerance and depends on, I guess, your view of what's happening in currency markets. But generally speaking, if you do go for hedged option, there's generally more costs involved. So it's either an increase in management fee, generally, in which case then it's a potential drag on your returns, right? So obviously there could be a benefit of hedging though, because if you're inserting yourself from a currency depreciating, then it's well worth paying the extra 3 basis points or 4 basis points usually for the hedge option. But yeah, there is a cost to it, and if you're paying the additional cost and actually currency hasn't gone down, and you would have been fine either way, you effectively lost out on that 3 or 4 basis points. But again, no one knows what's going to happen in the future, but it's just something to keep in mind. If you are going for a hedge option, then you've got higher potential costs to consider. Cool. Next, probably I'm just mindful of time, so we'll probably have time for just 1 or 2 more questions here. That may actually be it though. Just got a lot of repeat questions which we touched on already. Just make sure I haven't missed anything. I think that's about it. So, well, unless there's any other questions from anyone. Oh, okay, I've got some new ones here. So do PI funds pay tax on capital gains or just on dividends reinvested. So yes, PI funds don't pay any tax on capital gains. That's one of the key benefits of PI funds. Purely with PI funds, they just deem your return to be 5% every single year. So whatever you return, whether your fund returned 5%, 10%, 20%, negative 10%, doesn't matter. PI funds only treat their return as 5% when it comes to the foreign investments, in which case then you're simply just multiplying your PIR rate by their return. If you are investing into kind of non-foreign investments like kind of New Zealand shares, for example, then generally speaking, it's just on those dividends received. But yeah, short answer, no capital gains on PI funds. And last question now. With Foundation Series option, you have no currency exchange fee, but would need to convert money and pay something. Yeah, so although we don't charge a currency exchange fee, there is still currency that needs to be exchanged because we are buying a US-based ETF. It's just that we take care of all the currency on our side, and we've got the benefit of scale on our end and good relationships with the bank. So we've got pretty good rates when it comes to those currency exchange. But effectively, what we've done is instead of charging you an outright currency exchange fee and then a separate brokerage fee, and what they've done is just basically aggregate all into one fee, 150 basis point fee, and it covers every single thing about running the fund. So it covers trading costs, covers currency exchange costs, it covers fund management fees, it covers reporting, yada, 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 all the good stuff. And that's all you need to worry about. So although we're not basically calling it a currency exchange fee, there is obviously currency exchange involved, but you're not paying anything extra as an investor. So we've structured it to be pretty efficient in that sense. So we know that most other kind of brokerage out there charge at least 50 basis points just for currency exchange and then tack on another brokerage cost. So we think that we think that 50 basis point fee is very competitive, and plus you get the benefits of the PI tax structure and that super low 3 basis points in terms of ongoing management fee. So that fund's been very popular in terms of InvestNow customers, and it's just reflective of the fact that we've been very mindful of investors' fees and tax when constructing that fund. And we're always keen to launch more products that are cost and tax efficient within the Foundation Series funds. So we've got actually 4 coming up very soon, so keep an eye out for those. Great, so that's probably all the time we have today. Thank you so much, everyone, for attending today's workshop and for these series of workshops. Please, if you do have time, fill out the survey. We're always keen to hear feedback, how we can improve, how we can provide better education for you guys, better service. So please do take the time to do that. And if you have any other questions that we couldn't get to today, please just fire them through to us. We'll be sure to try and answer as many of them as possible. Otherwise, thank you once again for your time. And if you want to take control of your investing journey today, do check out the InvestNow investment principles, because there's something that you're going to be your best friends going forward in terms of your investing journey. So thanks everyone for your time, and we'll catch you on the next one. Cheers.